Upstart Holdings Inc. is down 21% on the day. It's currently sitting at $26.50 a share. What we're going to be doing is talking about the reasons why the stock has dropped, then looking at the financial statements and putting these in my discounted free cash flow model and my Buffett-Graham intrinsic value model to see if this stock is a buy or a sell. If you're interested in this spreadsheet, please visit my Patreon. Links are in the description down below. So, what has happened with the stock? Well, let's go to this news article here. Upstart plummets 22% after slashing quarterly guidance on inflation and recession fears. Shares of Upstart Holdings, a lending platform that uses AI technology, sank after cutting second quarter projections. The company now sees revenue of $228 million, down from the previous estimates of $295 to $305 million. Also, net losses were put at 27 to 31 million, deeper than the prior estimates, which were even break even and a $4 million loss. So that is a massive decrease, and that is why the market has reacted so negatively. Now, just talking about this stock overall, we'll go to the 5-year chart. What has this been doing? Well, it is down from its all-time highs of 390, down almost 93%. That is absolutely mad. In fact, if we go back, it's the lowest it's been. Let's go to the max chart, although the stock when the IPO then. This is the lowest price the stock has ever been. So is this the right time to get in? Are you not worried by this Q2 guidance? Let's have a look at the financials. So, income, 193 million, 227, 303, 310. We're on the quarterly here, sorry. 95 million, 162, 222, 846, and is now $1 billion in revenue. So that is good. Revenue is increasing, but if we look at the quarterlies, you can see that revenue was steadily increasing for the quarters, but as said before, it is now sliding, which is massive negative. Same thing on the profit. Net income is here. Profitable company, 158 million to the profit. And if we go to the quarterlies again, you can see profit was steadily, well, it was profitable, but increasing. And as per here, they're expecting now a 27 to 31 million loss. Next, what we're going to do is look at the shares outstanding. It's always something that I'm interested in. Are they buying back or issuing more shares? They have issued more shares, quite a lot. But the question is, when did they do them? Because the stock price has gone all over the place. If they were issuing more shares when it was at $400 a share, then that was a great bit of business for them. And hopefully they can use it to reinvest their capital. But normally we want to see them buying back. But with a stock that's had a 93% decrease, probably a good time to issue more shares. Now, finally, we're going to be looking at the cash flow statements. What's the free cash flow of the company? And interesting enough, it is, well, it's negative at the minute, minus 161 million. Why is this? Well, you can see that the operating free cash flow and CapEx is there. So CapEx has increased, but the operating free cash flow is negative compared to where it was in 2021, where it was positive, easy for me to say, free cash flow. So let's just get into the spreadsheet here. I won't show you what I've done, but I added all of the values that you can see below. There's the revenue, profit, shares, free cash flow. We've got analyst estimates and the WACC. So let me just quickly go how I get the analyst estimates. You go to Yahoo, you look at analysts, and this will load the revenues. You can see we've got average, low, and high. I took the averages 125 and 1.25 billion, 1.62 billion, and then the estimated growth of the company is 39% over the next 5 years. Now, these revenue numbers are going to be lower because of what we've read on the guidance, but we were going to use the numbers that we have here today. So, firstly, we're looking at discount free cash flow model. I've calculated the cash flows based on averages. And because it has a negative number in the most recent one, that's really going to skew it. So I'm going to assume that they're growing again. And this is with numbers closer to 2020 and 2019. So what does that give us a fair value with the stock? That's about $20 a share. Now that is if they are lower than they were in 2021. If the stock was about, let me just change some of the numbers here and see if we can get it a bit more realistic to free cash flow of 2021. If it was doing what it was doing in 2021, stock is a definite buy, $50 a share, but it is on the negative and trailing down. So I would say that price is going to be a lot lower. Buffett-Graham intrinsic value. What is that? Well, it looks at earnings per share against the expected growth rate. $1.73 EPS based on the most recent numbers. And the expected growth rate is 26%. I think this is going to really like this stock. And yes, it does. $107 a share is the fair value, Graham price of 80, which is with a good margin of safety. Now, you're thinking this is a definite buy, but as we've read in here, net losses are going to be increasing on the next quarter. So if this stock becomes no longer profitable, then Buffer Graham intrinsic value is not really useful here. It's going to say it's negative. So currently it does like it's a buy, but if this guidance is correct and the stock is going to the negative, it is not a buy and the models don't like it. If it can turn around, generate more free cash flow, get back into profitable at the price it's currently at, it does seem that it's got a lot of potential. Is it getting back to 400? I can't really say that for sure. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it. Subscribe if you're not already. Check out my Patreon, and I'll catch you guys next time.